Big surprise from the U.S. government this morning. Only 142,000 jobs were created in September. That is a lot lower than expected. The expectation based on a Wall Street Journal survey was 200,000. Now, the margin of error, when you're measuring all the jobs in the economy, obviously is very, very large. There are something like 138 million people working, so you're going to get it off by a little bit. But this really was seen as a shock, and one reason is that the last 2 months, they had been expected to be revised upward, were revised down. So it's a weakening trend. The trend, for the first time since the recovery, is slowing. We have less than 200,000 jobs created on average now so far this year, which means that 2015 may be the first year that job growth actually has slowed rather than increased. So what does this mean for the men and women who decide what interest rates are going to be at the Federal Reserve? Well, they're coming up on the 7th anniversary of zero rates this December, and the market had expected that by that anniversary, they probably would lift rates off of zero. Not a lot, but a little bit. The market actually had been expecting, or sort of had seen as a toss-up, moving rates off of zero by September. And now the so-called doves, which are not birds, those are people who want rates lower for longer, seem vindicated, and Yellen looks very smart for having waited. The hawks, who had wanted to push rates to lift off of zero at September or even earlier, are seen as retreating, and the market reflects that by the odds that they're pricing in of a Fed fund hike and by what date.